Good morning. My name is Joe Hoyle. I'm on the faculty here at the University of Richmond in Richmond, Virginia, where I do teach financial accounting, and I'm also the author of your financial accounting textbook. If you go back to Chapter 1, one of the things that we emphasized in Chapter 1 was decision making. It really should be something that we emphasize every day. Accounting is fascinating. Accounting is interesting to learn. But accounting is only helpful if it helps you make good, wise business decisions. And therefore, every time you look through a chapter, always think about how being able to know this information can help you to make good business decisions. In this video lesson, we're actually looking at a business decision. Your roommate's parents own a bunch of ice cream stores in Florida, and they're getting ready to expand. They're going to add on 3 or 4 new stores. Now, any time a business, whether it's an ice cream store or a grocery store or a restaurant or whatever, gets ready to expand, they need money. You need money for land, you need money for buildings, you need money for equipment, you need money to hire new people. Money is needed to expand. So if you're going to create or build a growing store, you need to be able to get money when you need it. And the roommate's parents have a couple of options, and they have chosen to go out into the bond market and sell some debt, some bonds, to raise the money. And this bothers the roommate. The reason it bothers the roommate is the roommate doesn't like debt. A lot of people don't. So the question the roommate poses is, why didn't they just sell some more stock? They could have gotten the money by selling stock. Why go to the risk of selling bonds? Why go to the risk of incurring this debt? Now, if you talk with a lot of business people, you will find that some love debt and some hate debt. There's always the question whether debt is good or bad. So if you're going to be a business person, you need to understand that there is a difference between issuing debt and issuing more shares of stock. Clearly, if you issue more shares of stock, then your portion of the company will be watered down. If you own 80% of a company and you issue more shares, you may only own 50% or 40%, and somebody else becomes an owner and can start telling you what to do. A lot of people don't like that. Debt, on the other hand, has some advantages and some disadvantages. More than likely, what your roommate doesn't like is the risk. Debt has to be paid. You have a contract. The contract says that you will pay interest when it comes due and the face value when it comes due. If you aren't able to make those payments, then the problem is that your credit rating is ruined, and you may be forced into bankruptcy. And if you're forced into bankruptcy, it's very likely that you'll lose the company. So they have that control over you. So if you're not sure that you can make the payments, if you're not sure that you can pay the interest and the face value when it comes due, then debt is probably a bad idea. However, if you can make the payments, if you're pretty sure that you have the money available to make the payments, then debt has a lot of advantages, and you at least should consider doing some debt if you're going to build a business. One advantage of debt is that the interest you pay, if you borrow $10 million and you pay interest of $700,000 a year, that interest is tax deductible, which means that you can take it as an expense on your tax return, and you can reduce your taxable income, and you can save some tax money. So if you pay $500,000 in interest, you might be able to save $150,000 or $200,000 in tax dollars. So the interest costs you less because you can save money on your tax return. Secondly, you can always pay off debt. Sometimes it's hard to get rid of other owners. But debt, if you have the money, you can pay these people off and you can send them on their way. It's not a permanent type of arrangement. So you do have that flexibility with the debt. The third thing that makes debt very attractive, and this is what a lot of people like to borrow money for, is called financial leverage. Financial leverage in its simplest terms means that you take someone else's money and you use it to make more money than it is costing you. So that the profits that you make are pure profits. They're profits that you made without your having to invest anything. And this very well may be what your roommate's parents are thinking about. For example, if they borrow $10 million on bonds and the annual interest cost is $500,000, and they can take that $10 million and they can make $900,000. I'm just making these numbers up, of course, but they can make $900,000 in profits off of that $10 million. Then they will turn around and pay the $500,000 in interest to the creditors, and they'll have a $400,000 amount left over for themselves. That $400,000 came without them having to invest a penny. And if you can make, let's say, $400,000 without your having to invest anything, that's a great way to have a profitable company. Yes, there's more risk involved with debt. You have to make those payments. But if you can make those payments and you can make sure that you're not put into bankruptcy or in any other way have your credit rating ruined, and you can make more profit off of the money that you borrow than the cost of that debt, then you have used financial leverage to increase your own net income without your having to invest any money at all. So, should your roommate's parents have borrowed the money? I don't know. I don't know all the facts. But there's clearly some reason for using debt as a good financing technique. So therefore, when you have to make the decision, should I expand my company by issuing shares of stock, or should I expand my company by issuing debt? There's good reasons to look at both. My name is Joe Hoyle. We're talking about long-term financing here in financial accounting. This, hopefully, in a few years will be you out there building a very successful business, hiring people and making profits. Have a great day. Thank you.